Buying your first rental doesn't have to break your bank. Here are 5 ways to keep costs down without cutting any corners. Hey, it's Bud Evans. Before we jump in, do me a favor, like, subscribe, and hit that notification bell so you don't miss my next breakdown. Buying your first rental property can feel like stepping into a minefield of unexpected costs, inspections, closings, fees, renovations, property management, insurance. It adds up fast and it goes on and on. But if you plan like an operator instead of a dreamer, you can save thousands and set yourself up for real cash flow from day one. So stick around until the end because I'm going to give you a free checklist that summarizes everything that I'm talking about here. It's something that you can use on every deal that you're going to evaluate. So let's get into it. These are 5 ways to save money on your first property without cutting any corners. The first way to save money, it's not after you close, it's before you even make the offer. If you're paying list price for your first deal and not buying it 100% with cash, you're already losing ground. The profit is in the buy, not in the sale. That means finding motivated sellers, finding off-market opportunities, or properties that need light cosmetic work, but not full gut jobs. You can use your AI tools like I created the real estate consultant GPT. The link is in the description, and that'll help you scan online listings for distressed keywords like as is, needs TLC, motivated seller, or bring all offers. Then move fast. Run your numbers, present clean offers, and negotiate based on real data. Keep the emotion out of it. You don't need to lowball. You just need to be the most certain buyer in the room. Clarity and speed are always going to prevail over aggression. And when you can close quickly and professionally, sellers are going to give you discounts that other buyers probably won't get. Rates are high right now. If you're waiting for them to drop, you could be waiting a very long time. The smarter move here is to structure a better deal, not wish for cheaper money. So here's what that looks like. See if you can get seller financing with below market interest. If that's not an option, you can negotiate a rate buy down or credit at closing to offset points and fees. You can also use portfolio lenders or DSCR loans that are going to be approved based on your property performance rather than your personal income. They're more flexible and a lot faster. You can even bring in a private lender, somebody from your network who wants a safe return secured by real estate. If you're not sure how to approach that, I'll show you exactly how inside the War Room with David Perret. It's a veteran network that I belong to, and there are a lot of people in there that can change how you raise capital. But the key is this. You can't control the interest rate, but you can always control your terms. The next money leak is renovations. Most first-time investors are going to swing a hammer before they build a scope of work. Don't do that. Walk the property with a contractor and separate out repairs that protect your asset from upgrades that just look pretty. Roof, windows, foundation, plumbing, electric, HVAC, and a lot of safety items have to come first. They're going to keep you compliant and protect your insurance coverage. After that, then you focus on the value-add improvements that are going to raise your rents or reduce your maintenance. This is things like LVP flooring, LED lighting, and durable finishes that are really going to last for you. Don't forget the price shop. You can use tools like FlipperForce. The link is in the description. It's a project management platform that I use. It's built for investors by investors. It'll help you organize your bids, your timelines, and your budgets so your rehab stays on track and on budget. Remember, we're not renovating to impress Instagram. You're renovating to improve your NOI. Even one rental can turn chaotic without a process. That's why I built Second Street Property Management. It's a systematized, investor-minded company that's designed to protect cash flow and tenant relationships. If you're in New Jersey, reach out and give me a call. But listen, whether you self-manage or you hire a manager, build these 4 systems before rent even hits your account. First, a leasing process. Next, a collections process. Next, a maintenance workflow. And last, a communications cadence. Create templates for listings, move-in inspections, maintenance requests, and document exactly how you're going to screen tenants. When you follow up on late rent, who does that? And who approves repairs above a certain cost? You can start small, use spreadsheets and email, but always think like you're going to manage 10 doors eventually. Systems will help you make that possible. If you need help structuring those things, do me a favor, go to budevans.com, book a free strategy session. I promise you it is not a sales pitch. I will walk you through exactly how to set up your foundation so you don't burn out or lose track of your numbers. I made enough mistakes. You might as well learn from me. This is the one that hits the new investors the hardest. They budget for your mortgage and taxes, but they forget things that chew up profit quietly, like your insurance hikes, your municipal fees. When you renovate something, they're going to increase your taxes, your turnover costs, capital expenses. You should be budgeting somewhere between 8 and 10% minimum for maintenance and capital expenses combined. Plan for 5% vacancy, even if your area is really strong. Make sure you're keeping reserves for each property, enough to cover at least 3 months I would prefer you did 6, but 3 months at minimum. And understand your local laws. Some cities are going to require things like rental licenses, annual inspections, annual COs, lead safe certifications, chimney certifications, roof certifications. If you don't account for those up front, they're going to blindside you later. In my management company, ﷺ Property Management, we think that surprises cost money and preparations make you money. So the more you document, the less you're going to lose. Now let's recap. These are the 5 ways to save money on your first rental property. First, win on the buy. Don't pay retail if you can. Negotiate with clarity, not emotion. Next, look for that creative financing. Use seller terms, private lending, or rate buydowns to your advantage. If you're a veteran, use your VA loan and house hack it. Renovate with a plan. Repair what matters. Upgrade what earns. Next is manage smart. Systems before you scale. Process always beats panic. Last, ensure that you are budgeting for hidden costs, maintenance, CapEx, vacancy, and those compliance items that are going to sneak up on you once a year, maybe $150 here, $150 there. Now, for those of you who stuck around to the end, I built a first property checklist that's going to cover all of this step by step, from your offer to your renovation plan and post-close systems. Go over to budevans.com, book a free strategy session, and I'll make sure that you get a copy of that free checklist. If this breakdown was useful, or if you like any of these other videos that I put out weekly, hit the like and subscribe button, tap the notification bell so you don't miss the next video. And if you're ready to turn real estate chaos into cash flow, connect with me in the War Room. It's where veterans collaborate, learn, and hold each other accountable. If you're managing multiple projects and you want to stay organized without spreadsheets, check out FlipperForce. It's what I use to manage my rehabs. All right, I'm Bud Evans. Aim high, execute fast, and I'll see you on the next one.